This is part 3 of a 3-part series. We're going to discuss how do you choose the right discount rate to utilize in your discounted cash flow net present value analysis. As a bonus, we're going to be looking at 4 very attractively valued growth stocks in the process. Hello everybody, this is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, aka Mr. Valuation. Well, this is part 3 of my series that I've done on talking about discounted cash flow analysis and picking the right discount rate. And one of the most widely accepted and utilized methods of valuing a business in today's world of modern finance is the discounted cash flow analysis. Now, obviously, to calculate valuation, practitioners must rely on mathematical formulas. However, the challenge with utilizing mathematical formulas to determine the net present value of a future stream of income is in determining the proper inputs. Consequently, the accuracy of our result is subject to the principle garbage in, garbage out. In other words, our calculations will only be as good as the data inputs we use when we run our formulas. Consequently, this presents a real challenge because 2 of the most important inputs to the discounted cash flow formula and net present value formulas require a subjective estimate of the future growth rate of the cash flows and their present value. Now, the velocity of the growth rate will obviously determine the magnitude or size of the cash flows you'll be discounting. The greater the amount of future cash flow that the business that you're looking at produces, the more value it actually has at the present time. This, to me, is simply common sense. Moreover, the next most critical input is in choosing the correct or best guess discount rate to apply. Unfortunately, no precise values are available. Instead, practitioners must rely on making the most reasonable assumptions and/or estimates for these critical inputs that they can. In part 2 of this series, I talked extensively about estimating future growth rates. In this part 3, my focus will turn to discussing the proper discount rate to input into our formulas. Because calculating the correct discount rate is critically important, and academics studying and teaching modern finance theory support the utilization of the capital asset pricing model as their preferred method for determining the correct discount rate to apply to their formulas. Now, Warren Buffett, the most famous value investor, talks a lot about discount rates. He favors using a 30-year Treasury bond rate as the discount rate. And here's the explanation that Warren considers as risk when calculating discount rates. Conventional academic and practitioners' thinking held that the more risk one took, the more one should get paid. Thus, discount rates used in determining intrinsic value should be determined by the risk of the cash flows being valued. The conventional model for estimating discount rates was the capital asset pricing model, CAPM, which added a risk premium to the long-term risk-free rate of return, such as the U.S. Treasury bond yield. Now, Buffett departed from conventional thinking by using the rate of return on the long-term 30-year U.S. Treasury bond to discount cash flows. Defending this practice, Buffett argued that as an investor, it implies avoiding risk, and therefore should use a risk-free discount rate. Consistent with his notion, his firm used almost no debt financing. He focused on companies with predictable and stable earnings. Here, as vice chairman, Charlie Munger, rest his soul, sat on the board of directors where they obtained a candid, inside view of the company and could intervene in decisions of management if necessary. Now, Buffett wrote, and I quote, "I put a heavy weight on certainty. If you do that, the whole idea of a risk factor doesn't make sense to me. Risk comes from not knowing what you're doing. We define risk using dictionary terms as the possibility of loss or injury." As a side note, Charlie Munger once quipped that in all the years he worked with Warren, he never saw him actually perform a discounted cash flow analysis. Nevertheless, as I previously stated, Warren Buffett did talk about it at times. On the other hand, academics like to define risk differently, arguing that it is a relative volatility of a stock or a portfolio stock. That is, the volatility as compared to a large universe of stocks, such as the S&P 500. They call this beta. Employing databases and statistical skills, these academics compute with precision the beta of a stock, its relative volatility in the past, and then build arcane investment and capital allocation theories around this calculation. In their hunger for a single statistic to measure risk, they forget a fundamental principle. It is better to be approximately right than precisely wrong, as Warren Buffett taught us. Although the capital asset pricing method is the most recommended calculation for determining the discount rate by academics, like Warren Buffett, I prefer a contrarian approach. However, before I delve more deeply into my views on the subject, I offer some additional Warren Buffett insights on his views of the proper discount rate, especially when you're using discounted cash flow analysis. And this is a quote. At the 1998 Berkshire Hathaway meeting, Buffett said, "We don't discount the future cash flows at 9% or 10%. We use the U.S. Treasury rate. We try to deal with things about which we are quite certain. You can't compensate for risk by using a high discount rate." And I believe that Warren Buffett is highlighting the principle that too high of a discount rate would calculate a net present value that would be unrealistically low. Conversely, using a discount rate that is too low will produce a value that is unrealistically high. This reminds me of the three bears porridge. It is no good if it is too hot, and it's no good if it's too cold. To be good, it needs to be just right. Now, Warren Buffett went on to say, and again I quote, "In order to calculate intrinsic value, you take those cash flows that you expect to be generated and you discount them back to their present value, in our case, at the long-term Treasury rate. And that discount rate doesn't pay you as high a rate as it needs to, but you can use the resulting present value figure that you get by discounting your cash flows back at the long-term Treasury rate as a common yardstick, just to have a standard of measurement across all businesses." I like to talk about the 15 PE ratio, and I'll talk about it more. There are two important points that I find valuable with the quote. The notion of having a common yardstick that provides a standard of measurement across all businesses seems like common sense to me. However, I would add that I would replace the word all with the word most. Second, I must wonder if Warren Buffett was, in his wildest imagination, anticipating a 30-year Treasury rate as low as we have recently been experienced over the last decade or so. By this time, you would probably think that Buffett simply uses the long-term Treasury rate while ensuring that the projected cash flows are pretty certain, so that you don't have to increase the discount rate to compensate for earnings risk. However, at the 1994 Berkshire Hathaway meeting, Buffett was also quoted as follows. "In a world of 7% long-term bond rates," Buffett said, "we'd certainly want to think we were discounting the after-tax stream of cash at a rate of at least 10%, but that will depend on the certainty that we feel about the business. The more certain we feel about the business, the closer we're willing to pay. We have to feel pretty certain about anything before we're even interested at all, but there are still degrees of certainty. If we thought we were getting a stream of cash over the 30 years that we felt extremely certain about, we'd use a discount rate that would be somewhat less than if it were one where we expected surprises or where we thought there would be a greater possibility of surprises." End quote. I believe the most relevant point that the Warren Buffett quote made in 1994 is that Warren Buffett's willingness to think his way through the process. In other words, he was willing to rationally adjust his views on the discount rate when economic conditions and interest rate levels dictated that he should. Now, this is clearly inconsistent with his remarks in 1997 and 98, where he said he does not adjust the discount rate depending on the riskiness of the projected cash flows. Also, in the 2000 chairman's letter, he wrote, and I quote, "The oracle was Aesop, and his enduring, though somewhat incomplete investment insight was a bird in the hand is worth two in the bush. To flesh out this principle, you must answer only three questions," Buffett said. "How certain are you that there are indeed birds in the bush? When will they emerge? And how many will there be? What is the risk-free interest rate which we consider to be the yield on long-term Treasury bonds?" Now, if you can answer these three questions, you will know the maximum value of the bush and the maximum number of the birds you now possess that should be offered for it. And, of course, don't literally think birds, think dollars, Buffett said. Finally, regarding the Warren Buffett quotes, I believe the real lesson is the need to always be willing to apply critical thinking within the investment process. To me, I don't believe Warren Buffett was being inconsistent as much as he was making rational refinements and adjustments based on the prevailing economic circumstances of the times that he was dealing with. The 15 PE ratio as a short-form discounted cash flow formula I have often written and talked about, and how I feel strongly that the PE ratio of 15 represents a valid and fair valuation proxy for most companies. For starters, the average PE ratio for the S&P 500 over the past 200 years has been somewhere between 15 and 18 or even up to 20 times earnings. I do not consider this a coincidence, as my own research has convinced me that there is a valid reason supporting a 15 PE ratio on most, at least average companies. I base this view on the earnings yield that a 15 PE ratio calculates out to be. This iteration is discovered by reversing the formula to earnings divided by price. This equals an earnings yield of approximately 6.67%, as I stated so much. Once again, I don't consider this a coincidence because 6% closely approximates the long-term return that stocks have delivered throughout history, 6 to 8%. There are times when, of course, it's higher, but that number often deviates based on valuations and economic conditions. However, during normal times, the 6% return seems like a reliable and reasonable expectation for returns on stock. Furthermore, I added additional color on the subject in part 1 of this series, which included views that Ben Graham had on the relevance of the 15 PE ratio. However, like most things in finance, it is not perfect or absolute. On the other hand, I do believe a 6% historical normal return relating to this 6.67% earnings yield leads me to believe that a 15 PE ratio offers a high level of credibility as a reasonable proxy for valuation. This also illustrates why I believe that a PE of 15 and its corresponding inverse earnings yield also represents a short-term formula for consideration as a proxy of fair value. Therefore, my own research and experience leads me to conclude that it also represents a reasonable discount rate to input into my discounted cash flow and or net present value formulas as well. Here are the inputs on a simple discounted cash flow for stocks calculator available for free on the internet. These parameters are current stock price, which is the most recent trading price for the stock, the discount rate percentage, which is the return you could earn on another security, sometimes called the guaranteed return, even if it's not guaranteed, trailing 12-month earnings per share, the trailing 12-month or annual dollars earned in profit per share of stock, the growth rate is applied in the very first year of the simulation. And then earnings growth percentage, the annual rate of growth you expect for earnings per share in the near term. Now, these inputs are already readily available on the FastGraph research tool, and the formulas are already programmed to our tool. However, like Warren Buffett, we have built in our own adjustments to these inputs for determining the correct discount rate to use. I'll talk more about that later. Therefore, we do take minor liberties with the parameters discussed. Instead of simply applying an arbitrary discount rate based on what we can earn on another security, we more specifically attempt to calculate what we can earn on the security in question. Like I say, mind your own businesses. As a result, we simply utilize our near-term earnings growth rates on the company we are researching and a PE ratio of 15 for most companies, which translates to a 6.67% discount rate. It's important to recognize that the earnings growth rate will determine the magnitude or the size of the future cash flows we'll be discounting. Furthermore, we believe in keeping our forecast as close or near to current as possible. We don't go out to terminal value or these long-term numbers that the classic capital asset pricing model favors. Now, the inverse of a 15 PE as a reasonable discount rate represents a generally fair valuation that can be relied on for most companies when you're trying to make sound investment decisions. Although discounted cash flow calculations are very popular, the viewer should recognize that they are simultaneously very imprecise. Anyone applying discounted cash flow valuation methods has an awful lot of latitude that they can take with the inputs simply because inputs are assumptions. Nevertheless, valuation matters, as I say often, and it matters a lot. And as reasonable, prudent investors, we should endeavor to be as rational when valuing a business as we possibly can. This does not imply perfection. Instead, it implies rational and reasonable calculations. Now, as usual, let's turn to FastGraphs and review evidence supporting my views. Now, in the introductory remarks, I also told you I'd be offering 4 fairly valued, very interesting stocks, and I'm going to tell you in advance that I'm looking at quintessential examples here. I'm going to be showing you what I consider quintessential examples. So you could argue that I've cherry-picked my examples to really illustrate my point. But the first one I'm going to look at is Global Payments Inc. And the focus here is not so much on the stock price, which is the black line. The focus is on the earnings line and the growth of the earnings line. Now, this is history, and the average has been 16.92%. Okay, and the PE ratio that we're using here is 16.92. So this is a little bit lower earnings yield than I would have on most stocks. I want to tell you that in advance. But going to the forecasting calculator, the growth rate future expectation is 12.81%. And with that number being, since it's below 15%, we will utilize the 15 PE ratio or 6.67% earnings yield. Now, I want you to understand what I'm saying here. What this graph is doing is it's actually forecasting future earnings or cash flows. We can look at cash flows because we have that option available on Fast Graphs. But the point is, this is kind of like discounted cash flow analysis in reverse. We're forecasting the cash flows. But unlike the traditional academic methods, I only like to go out 2 or 3 years. The current year we're in, what's left of it, and maybe 2 years out, sometimes longer, sometimes shorter, depending on the company and what's available. But what we're looking at here is the 12.81% will determine the magnitude, which we're calculating here, of our future cash flows, at least for the next 2.5 years in this example-ish. The 15 PE ratio is our 6.67% discount rate that I talked about. Now, what that will do for us is show us that I can get about a 25% rate of return out of this company by doing that. And the reason I get this 25% annualized rate of return is I get price-earnings ratio expansion, but I also get growth of almost 13%, and then I also get a little bit of dividend income. But you notice the dividend income has the least contribution to the value. The $10,000, using that example here, has grown to 18,200, or would grow to 18,210, and that's an 82% growth rate, and that's an annualized 24.8, which comes from PE expansion, going from the current 11 PE up to a 15 PE with a 12.81% growth rate. That all adds up to a 25% rate of return. But what I want you to basically understand here is we're essentially using a discounted cash flow process to determine the size of the future cash flows and then what valuation, what discount we will be applied, which is a 6.67% inverse of a 15 PE ratio. Now, with my next example, we're going to look at Cencora. And with Cencora, I want to emphasize, just like Global Payments, again, I've cherry-picked these examples because I wanted to choose, these are the kinds of companies I really love. And by the way, before I leave it, Global Payments is one of these companies that I said is a very high-quality company that's undervalued. That's one of the bonus features I told you about. So I just should have said that before. So we're looking at this perfect growth rate. The average has been 13.05% for this historical period. We're looking at the future growth rate, we'll call it 10% growth. And again, we're discounting that 10% growth at a PE ratio of 15 or a discount rate of 6.67%. And that gives us a lower rate of return than we would expect because you see overvaluation here. This is not one of the 4 stocks that is fairly valued. It's one of the great 5 that I'm showing in this feature, but unfortunately, this one has become slightly overvalued. With my next example, I'm going to look at Ameriprise, and I chose this for a reason. This company has historically grown at 12.8, but I want you to notice the market has historically valued it at about a 13 PE. Now going forward, looking at the forecasting graphs, we're expecting 11.19% growth. If I apply the normal multiple, this would be a 12.18% valuation or multiple or PE, and that's a little over an 8% earnings yield. So I'm discounting this with a higher rate, but I would get a 9.18% annualized rate of return, which would be slightly less than the growth rate because of the slight high valuation. But this one is still within the fair valuation corridor. So it's one of the 4 attractive, fairly valued stocks. And again, I would buy this if you could get it, especially on a little bit of a dip. The next one I want to look at is Elevance. And once again, I'm looking at a company that's perfectly the kind of company I like. Very consistent earnings growth, double-digit rates. It does pay a dividend. It has a low dividend payout ratio and a low dividend yield, but it's really all about the growth here. Now, the 13.34% historical growth is expected by the leading analysts, there's about 20 of them, 19 or 20, to be 12.21%. I'm using the 6.67% discount rate, or the PE ratio of 15, and this would give me a rate of return expectation that's very consistent with the growth rate that's expected. We're expected the cash flows to increase, or earnings to increase, by 12%. We're discounting them at 6.67. That gives us an 11.97. This is simply doing the work for you without having to do the fancy formulas. The next example would be Amdocs, and once again we see almost a 10% growth rate, 9.74. If I look at the forecasting calculator, it's expected to grow approximately at the same rate, so I'm going to be increasing my cash flows at around 10%. I'm going to discount them at the 6.67%, and that's going to give me a 15.9% rate of return, which is a combination of modest PE ratio expansion, 10% growth, and a 2.21% dividend that's expected to grow in the future as well. Another one of the fairly valued great companies. And then finally, last but not least, I'm going to show that Johnson & Johnson, the AAA rated company. And again, I'm trying to pick different companies with different growth rates here, because this company has averaged about 6.5% growth historically, even though it's a AAA rated stock. The forecasting graph expects the company to grow at 4.72% going forward, and using a 15 multiple, which is our 6.67% discount rate, I would expect to make about a 10% annualized rate of return on Johnson & Johnson. Now, I want to reiterate this. A couple of things that I differ with the classic discounted cash flow. I don't like to go out like 10 years like many of them do. And I don't like to add terminal value. You're talking about the future, so far out into the future that it's simply unrealistic to even consider it to be accurate. So I'm trying to use near-term estimates, and I'm trying to discount the next couple of years where I have some of that predictability and certainty that Warren Buffett talked about when I was sharing the quotes that he had on the subject matter of discounted present value. So what's the correct discount rate? You can utilize different numbers depending on your own wants, needs, desires, and beliefs. I like to use the 6 to 7% discount rate that represents the fair value for most stocks, as I've talked about. So anyway, there's the 4 companies I promised that I think are attractively valued today. And now let's go ahead and go on here, and let's move into the summary and conclusions, if you will, and talk about the fact that the essence of making sound and prudent investment decisions implies that the investor must make reasonable assumptions about the future to be successful. Moreover, we must also rely on the tools at our disposal to help us make the necessary and important calculations required to make sound, long-term decisions. However, we must also recognize and accept that it's impractical to believe that we can make perfect decisions regarding when to buy, sell, or hold a common stock. The best we can hope for is to make prudent and reasonable decisions. On the other hand, the last statement does not mean to imply that we shouldn't apply our best and most reasonable judgments. As long as we are accurate within a reasonable range of probabilities and possibilities, then it is feasible for us to make sound and profitable long-term investment decisions. These decisions do not need to be perfect to be of value. They only need to be reasonable and rational. But perhaps most importantly, we must be prepared to continuously monitor those decisions to stay current, and then make adjustments if necessary. Furthermore, let us also review my definition of what fair value represents. The central idea is to pay a price for a common stock that empowers the investor to fully participate in the operating potential the business behind the stock will provide. However, and this is important, please recognize that fair value is a calculation of soundness and prudence. Fair value itself does not necessarily indicate a high or even an acceptable rate of return. The rate of return expectation is a function of the growth potential of the cash flows or earnings that the business generates in the future. Now, finally, remember that estimations only provide a reasonable range of potential because, again, precision is impossible when dealing with the future. Nevertheless, estimates should not be merely guesses. They should be reasonable and realistic forecasts based on the best information that we can gather, always remembering that the only thing certain about the future is uncertainty. Anyway, this has been Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. aka Mr. Valuation. I hope you enjoyed this video, and if you did, please give me a like, ring the bell, subscribe to our channel, and then take a look at investing some of your time in fast graphs. I believe it's the best investment you can make for your financial future, because as I like to say, fast graphs are the value investor's best friend. Thanks for watching, and we'll talk to you again real soon.